This is part 2 of our chapter 10 video lecture. Back in part 1, I had mentioned that this part 2 was going to be about basis. But let's take a step back. Let's first look at that gain and loss formula where we start off with the sales price and then we subtract out the selling expenses. And the remainder is not the gain or loss, but it's the amount realized, from which we're going to subtract out that basis amount, here called adjusted basis, that we'll talk about in the part 3 video, our next video. And if the amount realized is larger than the adjusted basis, the difference is a gain. Remember, the general rule is we pay taxes on gains unless the law specifically allows the gain to be excluded or postponed. Or if the adjusted basis is larger than the amount realized, the difference is a loss. The general rule is that losses are not deductible unless specifically allowed to be recognized under the tax law. Let's go back and take a look at this sales price. We said it could be cash or property being received by the seller when they give up their old property. Because of the selling expenses, because of maybe mortgages paying off, what the seller may receive is not necessarily the gross sales price. Probably the most complex type of property sales is the sale of real estate, real property. And typically that's going to be handled by an escrow, a third-party company that will handle the paperwork. So the seller, or let's talk about the buyer, will put in their money, their cash, and then the seller will put in their property, really the good title, the legal title to the property. And the escrow company will make sure everything is properly recorded and aligned, and then the money will go to the seller and the title will go to the buyer. Okay, but to keep track of the sales price that we need to determine, possibly a document prepared by the escrow company is called a settlement statement. And if there's some financing involved by the borrower, typically we use a form called a HUD, Housing and Urban Development Statement number 1, where you can see there's columns of 4 numbers here, the left and right side. The right side is for the seller that's going to be receiving this sales price, and the borrower, this is the purchaser that eventually has to borrow money to buy the property. They also here have the same sales price in the same line. But there's other costs involved in keeping track of the money being flowing to and fro. So in addition to this section here, the seller may receive other types of money. Here, maybe including what's inside of the property, inside of the building, or being credited for amounts the seller had paid in advance for the benefit of the buyer, like prepaying 6 months worth of real estate taxes, and the owner here, the seller, is not going to be there for the next 6 months, so it's going to be credited to the seller here, and then and charged to the buyer. Okay, and then okay, so this is additional credits all here that's going to go to the seller. Again, including this sales price we're interested in. And then where is the money going to go to for the seller? It may have to pay off selling expenses, here called settlement charges. That's at the bottom of the next page, a whole page worth of settlement charges. Or here to be paying off an existing loan. Or maybe you're going to credit the buyer to take over an old loan. Remember we had talked about a loan assumption by the buyer. And here's other loans being paid off. And then amounts that the The buyer is going to pay later on for the benefit of our seller. So that has to be now charged to the seller. Ultimately, here is the amount of cash that's the seller is going to receive, which may not necessarily be close to the sales price. If you remember in that previous video, we talked about the equity in a property. This is pretty much the equity in the property less any selling expenses and not the sales price. So you cannot just look at the cash being received by the seller. Now keep in mind that at one time this seller had maybe buy the property. So maybe they have this HUD-1 statement as a borrower, as a purchaser of the property. And you have to keep track of that cost they bought it at, plus any settlement charges. Let's see, where is it showing up? Charges should be at the top here. Here it is, settlement charges. And how they're going to finance all of this, either through some type of down payment or assuming an existing loan, or taking out a new loan, or coming up with a balance due over here when all of this is closed in the escrow. Let's take a look at the page 2. So this is all the additional charges now, either paid by the seller or paid by the borrower. And of course, the big one for the seller would be the sales commission, typically charged to the seller. Now, these costs can be allocated based upon whatever they agree, yeah, the buyer and the seller, or the sales price can be adjusted to accommodate that funding of the costs. In the case of the buyer, the borrower, maybe a big upfront fee would be some type of points charged by the bank lending the money. And of course, ultimately here at the bottom would be the total additional closing costs for the buyer and the seller added to or subtracted from the proceeds in the first page. Again, this is called a HUD-1. And there may be other similar forms prepared either by the lending bank or some other type of financial institution. Now, this gross sales price is also recorded by the escrow company on a tax form here called a 1099-S. And you can see the gross sales price right here and the description of the property over here that's being sold. And a copy of this is going to go to the IRS. Here's the sales price. Not sales price, the sales date of sale. Okay, that's a 1099-S. Now, a common type of thing being sold, other property, is not real estate that we just covered, but securities, stocks, bonds. And the broker where that sale is taking place has to generate a 1099-B, B for broker. So we already saw a 1099 INT for interest and a 1099 DIV for dividends. But here now in chapter 10, maybe combined with those other 1099 forms, is for each sale, the broker has to give this information. And because there may be numerous transactions of buying and selling during the year, the broker may develop some type of their own proprietary statement that has all the same information. We'll see this tax form go to 8949 in chapter 11, how we report all of this individual stock sales. But here is the sales price, and here is the cost. And of course, the difference between the two in our formula is the gain or the loss. We'll also keep track whether the gain or loss is long or short term. If you held the asset for more than a year or less based upon the dates over here. And possibly one of these boxes should be checked off to determine whether it's long or short. and that'll determine eventually how the gain or the loss is treated, which we'll see in our next chapter. Okay, let's stop here, and then when we come back in part 3, we'll take a look at that basis or adjusted basis calculation.